So this is our opening range. It's a time period. Okay, it's a time period that begins at 9:30 and it goes up to 10 o'clock. That is the real opening range. So what your interest is you want to see what this dynamic range in time is doing. What's the highest high and the lowest low? And the first fair value gap that forms in this first 30 minutes, you want to extend that throughout the entirety of the day. Okay, all the way until 3:45 Eastern time, New York local time. You'll be surprised how often amazing trades will form off that first fair value gap in that 9:30 to 10 o'clock interval, that opening range. So right now, this is the lowest low. We want to see, does it expand down through it? The first probable level is that midpoint of the gap, and that gap is the opening range gap. The 15-second, the 30-second, the 45-second chart, I'm watching that as well. Generally, when I'm actively trying to take a trade, I'm looking at the 15, the 5, the 1 minute, and then I have that matrix template that has all of the 5, 4, 3, 2, 1, and then I have a 45-second chart, a 30-second chart, and a 15-second chart. And I'm looking for the first fair value gap that forms in those time frames if I have a bias. But whenever you have a gap up, which is where what we have here, we have yesterday's settlement price, and you determine that by going into regular trading hours. That's that price right there, okay? And you toggle that, or not toggle, but you annotate it, and you annotate the first tick opening price. That is your opening range gap. Now, when it gaps up like that, you want to find the midpoint of that, because many, many times you're going to see it trade to that level. It may afford you a setup. If there is a setup that yields a run from, say, maneuvering something up here off of a premium rate and starts to break down, and you get a fair value gap, say on a 15-second chart or 30-second chart or 45-second chart or the 1 minute, and it affords you a range from wherever that gap is to the midpoint of the gap. So what are you doing in the first 30 minutes? You look for the very first inefficiency, the very first fair value gap that forms in that 30 minutes. That's the one that the algorithm is going to, like, it's like the centerpiece, okay? It's the focal point for the daily range. Until we enter a trending day, that fair value gap can be used multiple times for multiple trades, both directions. But the mid part of that gap, whether it's an up gap, okay, so this is a premium gap. Why? Because we gapped higher than where we settled. So this is a premium opening range gap. If we gap lower than the previous day's settlement, and we say we open down here, that is a discount opening range gap. Same thing, as soon as you get the first tick at 9:30, you want to throw a fib on that just to get the midpoint. The midpoint, it's a 70% chance that that mid-gap level is going to get hit. Now, that doesn't mean that you're going to get a 70% chance of getting an entry that's profitable, that never got stopped out, that never had drawdown. It's just going to be a straight line run right to the mid part of that gap. It doesn't mean that. What I'm saying is 70% of the time from the opening price to 10 o'clock, that level gets hit 70% of the time. This is usually, not always, but it's usually likely to pan out. There has to be something else in the chart that's technically supporting the idea that it will drop down there and how to time it. What I'm saying is it's 70% likely between 9:30 and 10 o'clock that if we have a gap higher, or a premium gap in this case, that means that we opened higher than where we settled yesterday. The 50% of that gap, 70% of the time, it's getting tagged. It's going to retrade and reprice back down to it. It can, but you don't need this initially. It can go all the way back down and fill in the gap. Another instance is when you have this measurement like this, and you know where you have the higher gap opening and we're in a premium gap. You want to measure where your quadrants are. Many times you'll see it go down and leave a smaller portion of the gap opening, which is really what I love seeing that. Because say, for instance, say we're bullish, okay? What happens if it doesn't go down here and touch the midpoint of the gap? It means it's really, really bullish. And then what will happen is you'll see that the examples I've shown where I've entered in before 10 o'clock, it's using this logic. And then I'll have a runner that would hopefully probe any movement below the midpoint of the gap to see if I can get down to the lower quadrant. And then all of a sudden you'll see that's where my other partial was taken. And if I get a gap closure, I'm going to be a little bit higher than the full gap closure, because it can do what? In a perfect world, you want to leave a small portion of it open, because every gap invite the opportunity that it doesn't completely close in or fill in. You don't want to see them completely fill in, because that's rocket fuel. Let me get this line off here because this is now that. Okay, so that's the opening range low, and then we are trading at 10 o'clock, one more 30 seconds, we'll be at the end of the opening range. So then by that, you know you have the low, and whatever the highest high is, that's your opening range for the day. And you want to do quadrants on that and extend that throughout the entirety of the day. And if you have a macro overlap with that, with time, chances are you have a trade, as long as you know what side of the liquidity you're going to aim for. So we went above, and now right below this low, we have initial sell side, and buy side is here. So there's inefficiency between the low of the opening range, not opening range gap. We're inside the opening range gap, which is that blue shaded area. But we have sell side here and inefficiency down to previous settlement. So this is the part that's still open to inefficiency. So this part is the remaining portion that's lacking any buying and selling during the regular hours. It doesn't matter that we traded here in electronic trading or pre-session. It doesn't matter. Always give the opportunity for the day session, which is 9:30 to 4:15, to reprice into this area, both sides. Since there's no trading between the settlement price and this candle's low, there's no buying and selling booked at all, zero. Now, I'm not saying there hasn't been, because clearly if we go to electronic trading, you can see that we did trade through it. See that? So it's lacking what? Sell side. Now, here's a big paradigm shift. Since we passed up through it here, it's lacking sell side. So what kind of price delivery, if it wants to go back to the settlement, if it goes below this low, what type of price action would you like to see? If it were to go below this low, knowing that we have absolutely traded to the upside through it, so we offered what? Buy side. It's missing what? Sell side. So if it can manage to go below that, would you expect it to go below it a little bit and then shoot right back up real high? Or would you want to see it go below it and drift real slow and lethargic down to the previous settlement price? Or would you expect it to be, boom, one or two candles and get down to the previous settlement price? I would expect it to be quick and sudden to fill the gap. And what else is inside that area? That's today's new day opening gap. So we have a new day opening gap towards the low of the opening range gap and the remaining portion here. That level right there, the 20,001 level. Do you remember what that was? That's the rejection block, okay? If you go through the core content lessons, go to the lesson that's talking about rejection block, okay? And I have this little line here that explained to you why it was there. And also you understand that a rejection block can be used as a reversal pattern. That means if we have a high here and we're expecting prices to do what? Gravitate where? Well, we have an opening range gap. So if it can trade to fill the gap, or make an attempt to do so, and we're up here, where should the price draw to? Down. Okay, wonderful. Where can it turn to start going down? Well, you have to know your PD arrays. Initial high, that's the opening range high. If it goes above that and spikes through it, which it could have done before it even did all this over here, it could have went up there and hit that wick of the high on the daily chart. It never traded there. So because it failed to get there on this initial run, here's the opening bell, runs up, next candle slightly higher, and starts going back down. Where is it going back below? The rejection block right there on the daily chart. That's the highest up close in that price swing on the daily chart. We failed to get to consequent encroachment of that wick. Is that bullish or bearish? When we have an opening gap, that's a premium. In other words, we had all this, but this opening and rally up and then going right back down below the low and below that rejection block, we couldn't get to the consequent encroachment of that wick. Well, that's intel. That's giving you what? I can't even reach up here for you, ICT, so start looking lower. Okay, well, let's wait for the market to do what? Give us the mid gap. Well, it does that. There goes the whole 70% of the time. In this leg here, and it starts to rally back up, it goes right above the rejection block. Go back and look at the lecture lessons. This right here, that is a turtle soup. So, rejection block, it goes above it just enough to reject. If you go through all this price action, okay, go through it. What do you see? 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 What is this? That right there. That is the very first fair value gap. Well, let's walk you through it now. If we look at this, I said the very first fair value gap that forms between 9:30 and 10 during the opening range. This is your very first fair value gap that actually runs up into a rejection block with an opening range that has not completely closed in. We did get the halfway of the gap delivered, offering what? Opportunity to see if it can retrace and go lower. If we go above, these are if and then statements, okay? When we were trading here, I said, okay, we're at the top of the opening range gap. Once it trades above, It forces, if we trade below here, it will be a full gap closure. So you're watching price here. Now watch. First fair value gap formed. Now, if that's your fair value gap, and we went back below the opening range gap high, as soon as we do that, that is indicative of what? Seeking that, where the sell side is. And if it's going to go there, it's going to be a full gap closure. If it goes back into the range, it's going to go here. If it's going to go here, it's going to be a gap closure event. So how will we use that fair value gap if that narrative and logic is in play? Wait for it to trade down below it, then trade back up into it.